Five, four, three, two, and one. Hello, everybody, and welcome to another Capital Gains Tax Solutions and Commercial Real Estate Expert CRE Secrets podcast, and where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. And each episode, we are diving into advanced exit planning so you can create and preserve more wealth or help your clients, friends, and family do the same. I'm with one of my top strategic alliances in the country. And he is a certified financial planner. He's with Legacy Wealth Management. He's become a good friend of mine. And we're going to be talking today about eliminate the estate tax using the deferred sales trust. We think it's one of the best kept secrets, and we want to make it as simple as possible today. So please welcome to me with my co-host for today as we talk it out, Joe Walters. Joe, how are we doing?
Very good, Brett. How you been?
Better than I deserve.
Yes.
I'm excited to dive right in in fact, you can go back and see the full story of Joe on my YouTube channel if anyone wants to learn more about that. But today we're just going to dive right into the content, and we'll make sure to have the link and just look up Joe Walters on Capital Gains Tax Solutions YouTube channel. But Joe, certified financial planner. Let's just dive into the big challenge that you see a lot of ultra high net worth clients of yours that have, and others that might be listening. Talk about the challenges when it comes to estate tax, the death tax, and overall estate planning before we dive into the solution.
Yeah, as a certified financial planner, part of the big picture is the multi-generational planning. And so when we talk about how to properly pass assets down generationally, how to do that efficiently and in a way that leaves a legacy, which I'm passionate about. There's family members, there's charities, there's the transition of business, if you're still owning that business, and how that business can continue to function as you pass it down. These are all things that we help clients discuss. And the deferred sales trust is a major part of that discussion when it comes to exit planning. And as we run into business owners that have an acquisition price at a transaction price that's above the $5-10 million mark, we start talking about that they're interested in deferring. We start talking about the deferred sales trust 2.0 and how does that function, and how does that help them with estate taxes in the future? Because at this point, it's fairly generous. We can have about $22 million of net estate passed down without any taxes. However, that is set to sunset here very soon. So the question at that point is, what will happen? Will that come back down to, $2 million levels, $3 million levels, as our national debt has moved up tremendously in the last few years? You would think that they would look for ways to capture more tax revenue. So we want to think ahead of that, and having partners that think strategically like yourself, how do we use the deferred sales trust to reduce estate tax or prepare a client who they might be in an exit plan now, while there's a very high number of $22 million, but we don't know the future. So what can we do to prepare them for the worst case scenario?
Absolutely. And so the key points here is in the United States, the term death tax or estate tax refers to estate and inheritance taxes. The estate tax is a federal tax on the transfer of the estate of a deceased person. This tax is applied to a property or assets transferred through a will, or in cases where the deceased did not leave a will, the property is transferred based on state laws, individual state laws. And so some key points here to consider is, death tax is just another way to describe estate or inheritance tax. That's key. And then all assets that are inside of the taxable estate that are valued essentially $12 million per person right now as of 2023. There's a little bit of inflation that's kind of built in for that. But a good way to think about it is if you're married and you're worth about 26 million, you're pretty much good right now. If you were to die before these exemptions are set to expire in 2026, essentially, where it's going to cut in half or maybe even lower.
Yep.
And so what does that mean if you didn't do that? If you didn't do that, Joe, it's going to be a 40% death tax, right?
Federal.
So talk about how this has nothing to do with the stepped up basis, which often gets confused if people are doing 1031 exchanges and getting that, or just holding on to an assets and getting a stepped up basis.
Yeah. So, the bigger tax, right? If it does come back to that $5 or $7 million number, it's not very clear right now. But if it comes back down to 10 or 14 and you're worth 25, let's say, you've got yourself $11 million exposed to 40% federal. But if you're in California, it's another 10. So you're talking about a 50% total expense. And so that really is a big deal. Now, if we use a deferred sales trust, and one of the things that we won't be able to take advantage of there is the stepped up basis, right? And so the stepped up basis, that's going to allow someone who has a appreciated asset, let's say a zero cost basis, 10 million, instead of having a zero cost basis, when it passes down generationally, not spouse to spouse, it's going to have a step up basis to 10. And essentially in California, a $3.7 million tax bill vanishes. However, if we put that in a deferred sales trust, that deferral just continues and continues while the note passes down generationally. We don't get that stepped up in basis. So we have to balance those decisions and talk about the pros and cons of both situations.
Absolutely. Yeah. And so you might have in the past too, by the way, either bought a bunch of life insurance, because I'm sure if you're listening to this and you're worth a lot, your net worth is higher than these amounts. You probably have either bought a bunch of life insurance to maybe offset, because life insurance is basically, tax free upon your death. Your heirs will receive that payout on the death benefit to offset. You may have some charitable giving, or some of this is going to be set to charity. You may even try to gift as much as you can per year, per child. You're trying to gift away and moving funds outside of your current ownership to a living, heir, let's just say. And oftentimes we find these things are not as effective, not as efficient, not as effective, and also very expensive, right? Especially for life insurance purposes. And so what we're offering, or we're telling you about, is something that allows you in one sale of an asset to exit and eliminate all of the need for life insurance, gifting, or having to give it all the way to charity. In fact, it's called a Deferred Sales Trust Plus, also known as a DST 2.0, that can be used if properly executed prior to the close of your highly appreciated asset. It takes a few things. Joe, let's talk about that first one. A third-party buyer who's ready, willing, and able to buy an asset. In fact, we just helped a client of yours in the Sacramento area who sold a business and has maybe even additional exits coming up as well. But just talk about how that went, and then let's weave in how the DST Plus could be applied here for someone who's listening.
Yeah. So for this particular client, it is a real estate holding company. And so they're holding positions that were purchased by a publicly traded company. The total transaction was 17 million split between two partners. The one partner, that is my client, used the deferred sales trust to defer those capital gains, which in California is over 37%. So that worked out incredibly well. So instead of ending up with a net 6.3, he ends up with 10, 9.8, and 5 after expenses. And we're already, because of appreciation of the assets that have happened in the last 6 months, it's already well above that. So that was turned out to be an amazing story. Client's very happy with that. Now there's additional sales to happen. There's probably another $10 million, depending on the price appreciation of the real estate. But let's say that next $10 million goes through. A conversation's worth having about, if you want to defer the sales trust, let's talk about the second option here, the DST Plus, as it can allow him to defer the taxes and have the income stream, but in addition, reduce that total estate that's exposed to the estate tax if we revert back down to $5 million estate tax exemption instead of the 12 that we're at now.
Absolutely. And so what we were referring to is what's called a DST Plus, or Deferred Sales Trust Plus. It's also known as a DST 2.0, and it's really geared towards estate tax elimination, right? Which is different than capital gains tax deferral. Now, does a Deferred Sales Trust Plus also defer capital gains tax? Yes. Does a Deferred Sales Trust also defer income tax? Yes. However, the payments are based upon the life expectancy of the client. And what's important to understand is that when the payments come out to, let's say you are the seller and let's imagine you're married, right? You and it's the payments are based upon you and your spouse's life expectancy. It's a fixed payment, kind of like an annuity, although it doesn't have to be invested into annuities, although it can be, but it acts like an annuity in the payments based upon your life expectancy, where you pay some cap gains tax on every single payment and some ordinary income tax on the payment. And guess what? But upon the passing of you and your spouse, or just you if you're single, your beneficiaries of the trust, which can be your children, inherit estate tax free, because guess what? All of the exit into the DST Plus was outside of your taxable estate. And so let's just make this really simple. Let's imagine you have $100 million worth of a business or commercial real estate. Let's imagine you're fully depreciated and you're looking at a large estate tax bill. In fact, as of 2026, let's do some math here, Joe. If I took 100 and I minused, let's just say 12 million is the new number, then that's going to leave about $88 million inside of my taxable estate that's subject to estate tax. And if I take 88 million and I take that by 40%, that's about $35 million that's subject to estate tax. And so option one is stay where you're at, pass away, get a stepped up basis for capital gains tax purposes, right? Which is no capital gains tax at that point. However, the other side is estate tax. It's the next ledger. They go, well, how much is inside of the taxable estate? And they go, well, 88 million. That's not subject to exemption. Okay, 40% is due within 6 months. That's $35 million. And so now explain the other option, Joe. If they were to sell the asset today before they pass away, move into the DST Plus. Walk through that.
Yeah, before we do that, think about that from a large estate standpoint. 6 months to pay $35 million or $40 million in estate taxes, there's a liquidity event. There's a crisis of liquidity, right? Anyone who's that high net worth, they're not going to have liquid funds typically that are ready to pay those taxes. So if it is reinvested into real estate or it is reinvested into a business, they have a very short amount of time to capitalize that and to get out from under that, which in this environment, you're talking about a short 6-month window to get assets sold, which means a discount. Second of all, if you try to capitalize it, you try to borrow against it, you're talking about a very high rate of cost. So neither one of those things are attractive for our clients. So avoiding this event is critical for the family and for the harmony. I can't tell you how, especially if there's multiple trustees, how emotional this all becomes. You've lost your father, your mother, and you now have a very large estate. There's the family ties can be kind of torn, right, over this. Wait, you said this, I said that. And so we want to plan that ahead of time and make sure that whether it's utilization of corporate trustees and strategic planning is to get all of this laid out so that the family harmony stays intact. Because my experience is clients care a lot more about what their family feels about each other than they do even about their own money.
Yeah, very well said. And we're talking about escaping the crisis of liquidity with your estate by planning now, making exits now, so that you're outside the taxable estate, one, but also so you have harmony and I guess freedom to not feel like the kids or the heirs are going to have to really make tough decisions that can cause friction between relationships. And so let's walk through step one. Step one would be identifying how much is inside your taxable estate, number one. Step two would be, I think, even before this, what's your vision? What's your plan? What's the legacy you're hoping to leave with your wealth? So what does that look like, right? Fast forward, it's 10 years, 5, 10, 15, 20, 50 years after you've passed away. What are you hoping to have accomplished with the 10, 20, 50, 100, $1 billion worth of wealth that's passing to the next generation? And of that, how do we financially be great stewards, help you to be great stewards with that wealth? And how do you escape some of these crises that are looming? Okay, well, enter the DST Plus. Okay, so you can list and sell an asset today while you're still alive. And this is so key, because while you're still alive is the key determination if you can get it outside of the taxable estate before the triggering event, which is your death. Okay. And so we can sell today, and let's just say hypothetically it's $100 million worth of commercial real estate property in California, New York, New Jersey, a business, it's cryptocurrency, it's something that's highly appreciated. And upon that exit into the DST Plus, you now receive a promissory note back. So let's say it's 100 million, you're owed the 100 million plus a rate of return. But the key is because if it's in the DST Plus, we're outside the taxable estate. Not only are we outside of that 100 million as of that date, but also that growth of that. And so if you're still like, hey, I'm not even thinking about Deferred. I'm very young and healthy and all these things. And I have many, many more decades to go. Fantastic. Because not only is the 100 million outside now, but also the growth of that. So let's imagine you're an entrepreneur and you're like, okay, great. I just sold $100 million. I'm in my 30s, my 40s. I have many years for this to grow. And this grows to $1 billion over your lifetime. Guess what? All of that is outside of your taxable estate, which means what? It's not subject to the 40% death tax. Joe, you want to add, subtract, or highlight anything I just said there?
I mean, is absolutely true. The appreciation is often forgotten about, right? It's like, I got to take care of this amount today. Well, it's like, well, we're going to appreciate this asset over time. And all of that is exposed to this tax. And it's not just the 40% federal. You're talking about a state, a California, a New York. Some of these states can be brutal as far as adding on top of that, this 10%. And not only that, but you also have the cost of administrating and exiting that that estate. So having it pre-planned out with a DST Plus allows it all to be pre-planned. It just continues to flow into motion, passing down generationally. So I think this is critical for people to consider and to think about. And it's in combination with a number of other strategies and tactics that we'll discuss. So, there is a legacy for the children, a legacy for your charitable desires, for your business, whatever it is. We can kind of map all those things out and create a way that you can have where your assets go where you want them to go, which is probably not into the coffers of the IRS.
Absolutely. When we're talking about he's building a capital gains and a legacy wealth plan using the deferred sales trust as one of the tools. But I think part of this too is building and finding a team to help you plan out, to execute, and have guides to help you along the way. Joe Walters and I work every single day with individuals. If you're listening to this, for like yourself, high net worth individuals or business owners who have earned and built a lot of wealth and are looking for solutions to problems that perhaps even some of your own advisors over the years haven't been able to solve for you in a very flexible, durable way. And that's why we're focused like a laser on the deferred sales trust. I want to help you understand what it is, but it's not, and how it can be a part of your plan. You can go to rjlegacywealth.com, rjlegacywealth.com, and or capitalgainstaxsolutions.com. So Joe, let's talk about some of the, maybe the biggest, either questions that someone might have when it comes to the deferred sales trust. What would you feel like are the top one or two? And maybe we can talk about that right now. If someone's saying, wow, you piqued my interest, I'm curious now about this deferred sales trust. What's some questions that someone might be asking right now that we can try to answer for them?
Number one question is always, why haven't I heard about this? I have professionals around me. I've asked questions. I've actually gone through transactions where I've sold a highly appreciated assets. I paid the tax bill. I asked my professionals. They said there's nothing you can do about it. And here you are talking about a solution that no one shared with me. This too good to be true, right? So this is the most typical response we get. And so yeah, I would say that's number one.
Let's go through that, by the way. So I think this is great, right? So it seems like it's too good to be true. It feels like I would have heard about this before. I've been working with some amazing, smart, brilliant CPAs, tax professionals, financial advisors for many, many, many years, commercial real estate brokers. I know 1031 exchanges, I know nings and dings, and I know, donor advised funds and Delaware statutory trust. Like this deferred sales trust, why haven't I heard about it?
Yeah.
And I think what I found, and I've been working with it since 2009, Joe, is the biggest thing is the people who may have heard about it before, like other CPAs, a lot of them actually have heard about it. They just they don't have an intimate knowledge of doing it or actually seeing it done, right? And so it's one thing to have a peripheral knowledge, and you might even ask your CPA and they say, oh yeah, I've heard of those things, and they're kind of cautious or skeptical, or like, and rightfully so, because if they haven't been practicing it or seeing it actually implement it to successful outcomes, they're not likely to be excited about it or to have any thoughts on it in general, because they just don't know. In fact, the deferred sales trust is proprietary. It is protected. You need to be under NDA if you are a tax professional CPA, or if you're a potential client, under conditional engagement agreement to really dive into a lot of the underlining secrets of it. But at the end of the day, it's something that was created nearly 30 years ago, thousands of closes. It has a perfect track record with all of the audits, over 24 audits, state and federal. One of the largest deals is a $100 million deal in San Diego. No change, no findings on all the audits, private letter rulings. It's batting 1,000, but it's protected in that we don't want it to get into the wrong hands, and or for someone to take it and either try to hijack it or try to think they know what they're doing and then mess it up, and one of the audits gets broken and gets tied into, oh, it didn't work out. In fact, that is probably the most concern with us that offer the deferred sales trust, is that we do it in the right way, in the right order, so it doesn't get abused or doesn't get taken away. So I would say that's probably the first reason you haven't heard of it, is because it's only really one law firm that created this and then has been through the audits and has the track record, and they keep it highly protected. And that's our business partners that we work with. Joe, you want to add anything to that?
Yeah. I think if someone's hearing this and they go, I love this. This is a YouTube channel of a couple guys I don't know. So I'm just going to go to my team and ask them to create this deferred sales trust for me. So why can't they just go figure this out on their own, or grab their team and say, hey, I know this is legal, figure it out, find a way to do it and take care of it for me?
Yeah, great question. I think the key here is every tax deferral strategy works until you get audited. Mm-hmm. In fact, they work 100% of the time until you get audited. And then when you get audited, the question is, who's going to provide that audit defense and what's their track record on the audit defense? Now, I played basketball growing up, and Joe, you're right behind the Golden One arena there. Yep. Now, for those former Sacramentians in Sacramento, we're huge Kings fans, Joe and I. Yep. And we remember the Arco Arena days, right? Well, I remember Chris Webber, he blew out his ACL, right? And that was big. It hurt all of us. Now, I actually blew my ACL out too, playing college basketball. And I went to a doctor here at UC Davis Medical Center, just a few blocks from where you're at. And I remember sitting down with him and asking him some questions like, hey, if I get this surgery, how do I know I'm in the right hands? How do I know, that, this is going to be a good outcome for me? Like, for example, how many of these have you done? And he goes, thousands. I go, wow. And I go, probably he's thinking about 1,000 or so. And I go, great. Who else have you done it on? He goes, well, like Chris Webber and Ruthie Bolton. And I'm like, okay, got it. So you've done it with some of the best Hall of Fame, amazing athletes.
Yeah.
And it's been successful outcomes. Guess what? You can do surgery on my knee. And so I felt like I was in great hands. And so it's one thing to say, hey, go try something new, as if you walk into a surgeon and say, can you do an ACL surgery? And he's like, yeah, I've done some other surgeries that are similar to that. And I think I could put that thing together. And we would just say, you're risking, somebody to learn for the first time what has been proven for nearly 3 decades, right? And so you absolutely can try, but our question would just be, who's going to provide the lifetime audit defense? Who's going to pay for that audit defense? And are you willing to risk your 5, 10, 15, 20, 100 million, $1 billion exit on someone who doesn't have thousands and thousands of transactions under their belt, all of the no change IRS audits and the lifetime audit defense. And oh, by the way, we do a no cost, no obligation due diligence period where we actually bring in your trusted advisors. And if they sign the NDAs, we help them to get comfortable, because we're not asking you to just leave all of that behind. We actually want to bring them in, and they can be a guide to help ask great questions during the due diligence part of it. But the actual, let's say, surgery, the actual transaction is going to take professionals who have what I call the 10,000 hours working with the trust. Yep. Part of my role is the trustee. We can go on that a little bit later too, Joe.
I've been in this business for over 22 years and I love it. And I'll tell you this, to do great work for high net worth families, you need a team. I mean, I just want clients out there to imagine the legal, the tax, the financial planning, the quarterback in a room with a whiteboard, and we're talking about your family's desires that you shared with us, and we're mapping out a plan to present back to you to say, hey, this is how we can execute all the things you asked. And in fact, here's plan 1 and plan 2. What do you think about these different plans? And so I've made a point to find the best minds out there that can help my clients. And so finding Brett Swartz, finding Capital Gains Tax Solutions, finding this legal team to create a strategic alliance, to sit in rooms and whiteboard family situations and really think about what the best plan is for the clients. It's absolutely a necessity. And so just to kind of button this up on estate planning, I would say when you just talked about the surgery analogy, which is excellent, even more than the first deferred sales trust, but the second one, an estate plan that goes wrong is a devastating mess that is left behind by a family. And I've been there to clean them up and to help clients through those. But there's an emotional component to that and a financial component. And so helping those, I mean, it creates wounds and nobody wants to leave that behind. It is literally your legacy that you leave behind. So I would totally agree with you that we want to make sure that whoever's assisting in this has experienced it over and over and over again, and even wrote the book on it.
Absolutely. Yeah, we did write a book. Yeah, Building a Capital Gains Tax Exit Plan. And so with a lot of really great, smart people in the book as well. And that being said, we are going to wrap it up for the day. However, we're going to come back actually about 2 weeks from today, where we're going to share some of the other, biggest questions that people would ask on the deferred sales trust. For example, who is the trustee? That's Capital Gains Tax Solutions is our role. What is their role? How does that work? What kind of controls are in place and what protections are in place? Who's the financial advisor? That's Joe Walters. And how does he work as a part of the team as a certified financial planner and building it all out, as well as the legal team, talking about the legal team and their roles. So kind of the roles and the steps and a little more detail. As well, we're going to tie in the options for investing. So whether you're an entrepreneur and you want to be active and running your own deals, whether you are wanting to be passive, more retired, or a little bit of both, we're going to unlock some of those options for you. So make sure you subscribe to the YouTube channel if you haven't already. Go to rjlegacywealth.com to book a time right now with Joe Walters if you want to meet. If you wanted to meet with me, go to capitalgainstaxsolutions.com. Just mentioned you saw me and Joe on this episode. Joe, you want to add anything else before we go?
I love working with Capital Gains Tax Solution. It's been a joy. I love seeing families with this type of wealth keep this wealth and use it for their legacy, for their family, for their dreams, for their hopes. And if there's a charitable component to that, to see the community affected by it for a positive change, to be really world changers. And there's never been a wealthier moment in history, and there's never been a bigger transition where we see 70, 80 estimated $1 trillion passing down out of the baby boomers in transactions of exiting businesses and real estate and equities and all these different areas. And so this is a time that we can really help clients live out their best legacy.
Absolutely. And I'll list this last thing too. By the way, the deferred sales trust works for any asset of any kind, as long as you have $1 million net proceeds, $1 million gain. So we're talking about public stock, private stock, cryptocurrency, primary homes, business sales, commercial real estate. It can save a failed 1031 exchange. So if you're asking, I'm not sure if this works for me, it absolutely does. As long as you have $1 million net proceeds, $1 million gain. And we set it up prior to the close of escrow, prior to the buyer moving all contingencies. Unless you're in a 1031, then you want to make sure you're working with us. So we have a qualified intermediary who will accommodate. Okay. And so we're going to go into more of that again next week. But thanks so much for tuning in. We appreciate everyone out there. Please share this with someone that can make a big difference for their next exit, and reach out to us if we can be of